So welcome back. Now in this lesson, we shall talk something about option selling by the big sharks. You see, we are going to talk about derivatives, that is futures and options. So it is very essential that you should have a clear understanding of the futures and options. You should have adequate conceptual knowledge. Now these are my two courses. You may want to enroll for them, but not necessary that you have to take these courses. You may learn from any other course. You may see it from the YouTube or you may read books. But it is essential that before you proceed, you should have a clear understanding of futures and options. Otherwise, it will be very difficult for you to understand this lesson. All right. So now in the previous lesson, we have seen that how the big sharks can find out as to what the small traders are going to do. Now in this lesson and the next lesson, we shall try to understand as to how small traders like you and me can find out what exactly the big players are doing. But to find that out or to know that, we need to understand something called as put call ratio or PCR. But to understand PCR, we need to understand the significance of selling options by the big sharks. So before we actually get on to the put call ratio in the next lesson, let us try and understand something about selling options by the big sharks in this lesson. All right. Now just to recapitulate, we all have seen this in the previous lesson. We know that the big sharks are more wise than us. We know that the big sharks have much deeper pockets than us and therefore they can fight for long. We all agree with this? Alright. And if you are clear about the concepts of options, then you would also know that selling options require huge margin money. And it also requires an ability to take unlimited risk because people who sell options have to take unlimited risk. And certainly, because of these reasons, people who sell options are more wise, isn't it? And all these things can be easily done by the big players for obvious reasons. These reasons, huge margin, unlimited risk. So, therefore, small people like you and me would normally not indulge in selling options unless we are wise enough, like the big sharks. Okay, so now once we know this, we'll have to remember two things in our mind always. Number one, that selling options has more significance. Why it has more significance? Because selling is normally done by the big sharks and we are trying to follow the big sharks. Therefore, selling option has more significance. And secondly, we have to see the selling of options from the big players' point of view, not from our perspective, but from their perspective. All right, because we want to do the same things what the big players are doing. Therefore, we have to look at that from their point of view. If the big people are selling call options, we need to find out why they are doing that. And if they are selling put options, then again we need to find out as to why they are doing that. Once we understand that, then we will also try and do the same things, isn't it? So let us take call options first. All right, selling of call options. Now, when would a small trader like you and me sell call option? When will we do that? Obviously, we will do that when we think that the price will not go up, isn't it? Because otherwise, if the price goes up, then I would rather buy call option. I would not sell call option as a trader, isn't it? Because I'm trading. All right. But why would the big shark sell call option? Will they do it for the same purpose? No, their purpose is different. They are doing hedging. They actually want the price to go up. They would be having some portfolio which they may be wanting to grow. They may have analyzed that the market is likely to go up. But just in case the market does not go up, therefore they are selling these call options as a hedge. If the market does not go up as expected by them, then they would recover some loss from this option position, from this hedge of selling the call option. Got it? Little confusing, don't worry. Let me try and explain to you with an example. Let us say that today Tesla is trading at $200 per share. Okay, the market price today. And a big player in the market has got 5,000 Tesla in his portfolio. So 5,000 Tesla multiplied by 200, that means $1 million worth Tesla he has got in his portfolio. Just Tesla itself is about $1 million in his portfolio. And he has done his homework, he has done the analysis. He thinks or he expects the price to go up from 200 to 250. Alright, so he is bullish on this. So what will he do now? Just in case the price does not go up, he has to cover himself, isn't it? He has to protect his portfolio, like we have been talking about stop loss and counter trade. He is also wise enough. So just in case the price does not go up, he has to hedge his position. What he will do? He will sell 50 lots of Tesla call options. Why 50 lots? Because each lot has got 100 shares, so 50 will make 5,000 for him. And he will sell at a strike price of 250. Why 250? Because his analysis is telling him that the price will go up to 250. So till 250 he is safe on this option. He will start losing on this option since he has sold only if the price goes above 250. And let us say the premium that time is $10. So he has pocketed 50 lots multiplied by 100 in each lot multiplied by 10 as the premium. So $50,000 he has taken as premium from the person who has bought from him. Okay, he has sold call option. Now imagine, let us say Tesla price does not go beyond 250 till expiry. Alright, let us say the price comes up to 250, or let us say it comes to 240. Okay, so if the price comes to 240, that means for 200 to 240, 40 rupees per share. So 40 multiplied by this 5,000 shares, okay, that means about $200,000 he would gain from his portfolio. At the same time, since the price has not crossed 250, he will retain this premium also. His aim was not to retain this premium, but now since the price has not gone beyond 250, he is happy. He will retain this premium. His portfolio has also grown. At the same time, he has got this premium also. Got it? Now let us say that the price goes up to 260 till expiry. On the day of expiry, the price is 260. So what happens? His portfolio, which was at 200, now it has become 260. So 60 multiplied by 5,000, 300,000 his portfolio has grown. Alright. So practically he is no profit, no loss on the option. See, actually his option, he had taken the premium of 10 for this price, 250 strike price. Now since the price has gone to 260, this $10 which he had taken, this 50,000, he would have to return back to, he is back to square one. This 50,000, the premium is going back, but his portfolio has grown by 300,000. Got it? He was not interested as it is in these peanuts. His interest was on this. Now imagine a situation if the price goes beyond 250 or beyond 260 also. Let us say at expiry the price is beyond 260. Let us say it has become 290. In that case, what happens? The big shark will lose on the option trade. Beyond 250, he is losing. Till 260, he has given back the $10 premium. And from 260 to 90, that means $30 per share multiplied by all this lot size. That much he will be losing on the option trade. But his portfolio is growing, my friend. His portfolio will grow. From 200, if it has become 290, so $90 per share multiplied by 5,000. So his portfolio will keep growing. Got it? So till 250 he is gaining on the portfolio as well as he is gaining on the premium of this option. If the price goes, Tesla price goes beyond 250, then at least 250 he is gaining, but beyond 250 he is no profit, no loss. He is earning on his portfolio, but he is losing on his option. He is balanced. But till 250 he has gained on his portfolio. Try and understand that. Alright. Now let us take the example of put option in the similar manner. We shall take the same example. Alright. When would a small trader like you and me sell put option? We would sell put option if we think that the price will not go down. Because if the price were to go down, as a trader, I would not sell put option. I would rather buy put option, isn't it? But if I am selling put option, then I am thinking that the price will not go down. What about the big players who are selling as hedge? They are not trading, they are hedging. Their point of view is different. All right. So the big players, when they think, when their analysis tells them that the price will go down, then they will sell put option, unlike us. Why? Because they actually want the price to go down. They may have taken a short position in futures. Okay, so they will earn on the futures only if the price goes down. Their aim is to earn on the futures, not on this option. But just in case the price does not go down, if the market does not behave the way they want, then at least they will recover some loss in this option trade. So the option is for the purpose of hedging. So again, little confusing. Don't worry. Let me explain to you with the same example. All right. Let us say today Tesla is trading at $200 per share, the same as we had discussed earlier. All right. And a big shark has shorted 50 lots of Tesla futures. He has gone short on Tesla futures. Why he has gone short? Because he is expecting the price to go to 150. From 200, he is expecting the price to come down to 150. Therefore, he has gone short on Tesla. Alright. He is having a short position of 50 lots multiplied by 100 shares in each lot multiplied by 200 the price. So he is short by $1 million. Alright. But what if the price does not go down? He is banking on the price to go down, but just in case the price does not go down, then what? Then he has taken a hedge. He sells 50 lots of Tesla put options at a strike price of 150. Why 150? Because he is expecting the price to go down till 150, and so he wants to be safe till 150. So if he is selling put option till 150, he is safe. And let us assume that the premium for the put option at this strike price is also $10. So 50 multiplied by number of shares in each lot multiplied by this premium, $50,000 premium he has taken from the person who has bought the option. Okay, his intention is not this. He is not intending to gain this. His intention is something bigger. All right. His intention is he wants to gain from the futures. Let us see how he does that. Now imagine that if the Tesla price does not go below 150 till expiry. Okay, till the expiry date, let us say that the price of Tesla from 200, it comes down to 160. It does not come to 150. So if it has come to 160, what happens? Because it has not come below 150, that shark will retain this premium. He is happy. Though his aim was not to retain this, but now he's retaining it. He is happy with this 50,000. At the same time, since the price has come down from 200 to 160, $40 per share into this 50 lots. So $200,000 he is gaining on the short position in futures also. 200 on the short position in futures plus 50,000 this. So he is very happy. Alright. Now let us say another situation. If the price of Tesla comes down below 150, Let us say it comes down to 140 till expiry. Then what? Now because it has come down below 150 till 140, this 10 rupees difference, what premium he had taken here, that premium he has to return back now, because he is losing that. Till 150 he was safe. Now since it has come below 150, it has come to 140, this $10 what he had taken, the $50,000 he has to give back. But imagine his futures have gone up by 60, from 200 to 140. That means 60 multiplied by this lot size multiplied by the number of shares in the lot. So $300,000 he has profited from shorting the futures. That was his primary aim. This was just a hedge, a safety measure. Okay, so he has gained this much. Now imagine a third situation. Let us say the price goes even below 140. Let us say the price goes to 100. Then what happens? In that case, he would be losing in the option trade. Below 150, he would be losing. So from 150 to 400 to 140, $50 he has lost on the option trade. 50 multiplied by whatever. So about $25,000 or whatever. You see that about 25,000 that he would lose on the option trade. But imagine his future trade. Future from 200 it has come down to 100. That means $100 per share. He has shorted the future. So here he would be gaining almost about $5. Okay, 100 into 50 lot size into this 100 number of shares. So almost about $500, $500,000 he would be gaining on the future position. Okay, so that is why he had taken the hedge. Have you understood now? The purpose of you trading in option and the purpose of the big players trading in option is entirely different. Let us summarize it like this. If the big sharks are selling call options, they are actually expecting the price to go up. We, the small fish, the small traders would sell call options when we expect the price not to go up. But the big players, they are actually expecting the price to go up. Shorting the call option is just a hedge which they have taken. A view different from our view. Okay. So if you can summarize it like this, big sharks selling call options, that means they are expecting the price to go up. So be prepared that the price will go up. You have sold the the call option thinking that the price will not go up, but actually the price will go up because that is the view of the big sharks. Similarly, if the big sharks are selling put option, they are actually expecting the price to go down. You may be expecting the price to go up, but they are expecting the price to go down because they have taken a hedge. Shorting put option is a hedge against price not going down. Actually, they want the price to go down. Okay, so the big sharks selling put options means they are expecting the price to go down. So if you have to think like the big sharks, then you have to think opposite of what you were thinking. You have to think like this. Got the point? Quite confusing this lesson, I understand. So if you have not understood much of it, it is absolutely normal. Do not worry, you are fine. Try to watch it again. Still, if you don't understand, try to watch it a third time with a fresh mind every time. I'm sure you will understand. You watch it calmly with a fresh mind. Each sentence you try to analyze and you will understand. But if you still don't understand, it is okay. Try again. The subject itself is little confusing. Technical analysis is not so easy, gentlemen, and the ladies, of course. But if you have understood the lesson, which I'm sure you will understand at some stage, in that case, with the help of this lesson and the previous lesson, with the help of these two lessons, what we will do, in the next lesson, we shall try to understand the put-call ratio. To understand the put-call ratio, the current lesson and the previous lesson are very important. So before proceeding to PCR, please try and get your concepts very clear on this current lesson and the previous one. If you have any doubts, any questions, please do not hesitate to contact me. All right.